For an oil and gas extraction entity, the key determinant of its profitability and what return investors are going to get is probably going to be the size and the quality of the deposit. So that's a natural endowment issue, the size and the quality of the deposit. That will also be influenced by how much capital has to be invested to extract the oil or the gas from the reserve. That's going to have a huge impact on the return, and that's going to affect the business model. Pre-production investment required, such as for feasibility, the environmental impact assessment, regulatory approvals, moving or relocating people, these are also going to impact on the returns that a project can generate. The proximity to markets also has a huge impact on oil and gas projects. Frequently, some of these end up being stranded assets, especially in places, isolated places on the African continent. There are sometimes significant endowments. The difficulty is getting them to market. So the business model simply does not work because there isn't proximity to markets or there's an adequate infrastructure to get the product to the market. Obviously, the level of debt is going to influence these business ventures as well. The higher the debt levels, the riskier the project is perceived to be, and the higher the interest service requirements. The lower or more conservative the debt levels, the more moderate or less risky the project is perceived to be. Oil and gas projects are inadvertently affected by commodity prices. So they will fluctuate in terms of their profitability based on the underlying commodity prices. In addition to that, exchange rates will be an issue where the domestic currency is not a US dollar currency because these commodities are priced in US dollars. Finally, these ventures will have to consider environmental considerations because these may impact on their license to operate, and costs of extraction per unit of output will determine the efficiency and ultimately the profitability of oil and gas ventures.